Instead of a disclaimer, I'll put a QR code there because they all say the same thing, and that will take you to the presentation on our website. So I'm the Managing Director. This is my first time here, and it's actually been really interesting. Just a corporate snapshot first. The board and management eat their own cooking. We have a lot of skin in the game here, and we're here to build a really good project, a really good company. So our market cap is only about 22.5 million right now, and I'll go through the value proposal later. But we've got quite a low enterprise value per ounce. We do have a little bit of corporate pollution on the balance sheet there, some options and so, but it's not too much so, and the convertible notes should be out of the way over the next month or so. Myself and David Hobby have been working together for over 10 years, and we've looked at projects mainly in Asia and South America, but we've got a lot of experience together. So I'm an ex-project financier and he's an economic geologist, and together we sort of are able to work out what projects we think are the best to put our time and shareholders' money into. Our strategy right now is just gold and copper. And the reason we're looking at gold and copper is that these are deep markets. So on the supply side and the demand side, so long as we can deliver a copper con or a cathode or a gold doré into the market, and we're cost competitive, we have a market. We don't have to do anything else but do that. And for small companies, it's all about reducing your risk. And we felt that copper and gold would get us a long way to doing that. We're looking for projects in low-cost jurisdictions, so we're focusing on Chile at the moment. Chile is the largest copper exporter, producer and exporter in the world. It's got massive infrastructure. It is a lower cost environment. It's not the lowest, but it's reliable. It's got a very solid mining code. It's got free trade agreements with all the countries that matter, and that means asset protection, and that means investor protection. We're only looking for projects which are lower in capital intensity and have the OPEX or the metallurgy, which gives us a low OPEX. So we'll go through this, but we're looking at heap leach gold at the moment, and we think this project's a real winner. We want projects which are proximal to infrastructure. Not every project is perfect, but we want to get as close to ticking all the boxes as possible. And with Pantanillo, which I'll go through, I think we will achieve that. You'll see on this chart here that there's a gold patch. That's called the Maricunga Gold Belt, a very rich gold belt in South America. And you'll see some of the names there. So down the bottom, we've got the old Filo de Sol project, which was bought by BHP in London not long ago, was in the news. So big projects there. And then right up at the north, we've got Goldfields with their gold project there, and a whole heap of projects in between. So before we head into this too much, I wanted to talk about our focus. And our focus is cost and capital intensity. And in our view, that's all that matters. Grade does not matter. So I've got this chart here. It's Aussie and New Zealand gold producers, and I've marked two companies on there. We've got Capricorn's project in Western Australia at the bottom of the cost curve, and it's one of the lowest grade projects in this producer peer group. Its head grade is 1 gram, its resource grade is 0.7 grams. And then at the top of, or the middle of the third quartile of the cost curve, we've got Costerville, which is the highest grade project in this peer group, yet it's one of the most higher cost project. So what I'm trying to show here is that grade is not king. It's your project economics, it's your metallurgy, it's your cost environment. All these things stack on top of each other, and that's what makes a project. And that's why we're looking at the project we're looking at. So the Pantanillo Gold Project is located in Chile, as we've discussed. We just purchased this project. The history is it was owned by Anaconda, then Anglo farmed it out to some big players, including Kinross, collected all that data, and then in the late teens let the project go because it's only got 1 million ounces in it, so it's too small for them. Picked up by a Chilean group, and we did a deal with the Chilean group. So we picked up 1 million ounces. It's an NI 43-101, but For all intents and purposes, that's the same as JORC, 80% measured. So it's a really strong resource, and there's a lot of upside. The project grade's 0.69 grams a tonne gold, and that's why I was talking about the cost curve and where the grade is king. So what got us really excited about this project was what was happening around us. So 12 kilometres from us is the Vulcan project owned by Hochschild. It's actually just in a transaction now, but for today owned by Hochschild. It's got about 11 million ounces in it. It's got a PEA about 2023. It's grading 0.63 grams a tonne, and its AISC is around $1,002 US, so about $1,500 Aussie. So super cheap. And then we've got Phoenix project owned by Rio 2, TSX listed, market cap in Aussie dollars of around 775 million today. It's got 1.7 million ounces, or thereabouts, of proven and probable, grading 0.48 grams a tonne. Its AISC is 1237, so that's about 1850. It's about the same as Saturn, who's also got a heap leach project here. So very low cost environment. Around us, within a 35 kilometre radius of our project, Pantanillo, is 65 million ounces of gold and resource, and in the Maricunga gold belt, there's 100 million ounces of resource. And you can see there we've got some of the biggest names in town as our neighbours. So this is a really interesting area to operate. We've actually got the smallest project. On cost and heap leaching, and you would have seen a similar chart with Saturn, and you can see that the average grade for heap leach projects for this small peer group is around 0.5 grams a tonne. We're at 0.69. We will be delivering an updated and JORC compliant MRE later this year, where we expect to grow the resource, so that grade will come down a little bit. You can see Hochschild, which I just mentioned, with that massive resource there, grading at 0.63 or so, and then Phoenix under the average at 0.43, but still a very low cost operation. Now back to the cost curve and why I've pointed out those projects. So this is that cost curve we saw a few slides ago, and even though it's apples and oranges, because these are projects which are not producing yet, but you can see that both projects are actually in the bottom decile of the cost curve. And in fact, Saturn's Apollo Hill is around there too. So given our grade is sitting around 0.69 grams a tonne, we would expect that if everything goes well, we'll be somewhere there too. So it just shows how low cost these heap leach projects are, and that's the big advantage. The capital intensity is low, the operating costs are low, and that means that the project is bankable and doable. Now this is the value upside, or this is where we see the opportunity for us right now, and this peer group here is a selection of ASX and TSX companies without a PEA, so it's all pre-feasibility of any sort. They range in jurisdictions. There's some from WA, like GG8. You can see that Andean silver, which is also in Chile, is there on the left-hand side, and so on. So right now we're valued at around $22 an ounce. The peer group here averages $117 an ounce. We think our project is better than the average anyway, and so that's where we see our value trajectory. And then to reinforce that value trajectory, we've got this slide here, and we can see our project there at $22 an ounce. So we're slowly moving towards feasibility. First cab off the rank is a JORC MRE update. But we can see Saturn Metals there, valued at around $250 million today. And then Phoenix, which is just up the road from us, valued at $775 million today. So this is why we're doing what we're doing. These heap leach projects are bankable, they're low cost, and they can really produce big profits. So let's just focus on the project now for a little while. So Pantanillo is around 110 square kilometres, and you can see in this chart here there are two little green areas, one between T1 and T2. That represents the footprint for 1 million ounces of gold. And then that other green footprint is the Vulcan project, which is 12 kilometres on trend from us, and that represents 11 million ounces. And you can see those lighter coloured areas where we've listed them T1 through to T7, and that's volcanic alteration, and that's what we're chasing in the Maricunga Gold Belt. So our project, our resource right now is in volcanic alteration. We see opportunities for a long strike increases through T1 and T2, and then T3 through to T7 are exploration prospects. So that's a future upside for us. So the block is it's a really robust exploration block. There's a lot happening in there. We get to start with a measured resource. Converting to JORC should be relatively easy because we're talking to the competent or qualified person who originally did it. And then we can move forward, and we expect to build quite a big project here. Here's a really nice looking cross section. The actual footprint of the resource is 850 metres long by 200 to 600 metres wide, so it's really fat and wide, and it's sitting on top of a hill, so the strip ratio will be reasonably low. And you can see here some really great intersections here. These are blowing our mind because we've got a resource of 0.69 grams a tonne, but there's some intersections there which are hundreds of metres long and over a gram a tonne. And we did a release 2 weeks ago with about 10 super long plus 100 metre gram by metre intersections. The longest one was, I think, 450 metres. You can see the pit shell outline there, and you can see a lot of potential under the block, but the pit shell is focusing on the oxides and the mixed zone, so that's what we'll be heap leaching, and that's what we'll be focusing on going forward. The sulphide zone underneath is a bit different. It might come into inferred, but that's sort of something we'll look at further down the track. The way to look at it is we're looking for a 10-year mine life on the oxide and mixed, and then in 10 years we'll look at the sulphides and see what we can extract from that. We released some metallurgical test work yesterday. This is care of Anglo, Kinross and Orosur, who were involved with the project before. And the oxides were leaching to plus 80% recoveries within 30 days through column leach test work. On this chart you can see that orange line, so Phoenix is doing a dump leach, no crush or anything, they dig it up and dump it, and their recoveries get up to 75%. The curve's a bit flatter to start with, but ultimately they get to where they want to, and that's recovering gold, and that's what it's all about, recovering gold for as low cost as possible. So these are really exciting numbers. They give us a really strong pathway to a really strong and profitable project. This is the plan view, and I'm just going to jump through a few cross sections here, but what we'll be focusing on, and I'll reiterate this in a minute, is delivering or JORCing our current mineral resource. We expect to do that in November, December, and during that process where we're going to get our first ounces, so how we grow from 1 million ounces to something materially larger, we're going to focus on cut-off grade first. So this resource was cut on a 0.3 cut-off back in 2010. Our neighbours are using a 0.15 cut-off for resources, and so we should see a whole lot of gold come into the mineral resource estimate without drilling a hole. Secondly, when we do our resource, we'll be recutting the pit shell using today's economics. So back when this resource was put together, the gold price was $1,035. It's much higher today, but also the cost environment in Chile hasn't accelerated with the gold price. So what we're going to see is a wedge effect to our favour between cost and the current gold price as we recut our pit shell, which is going to bring more ounces in. Will allow the pit shell to expand a bit and capture some ounces around the pit. Then we'll be looking at extensional and down dip drilling. So we expect that in some parts of the current MRE and around it, the drilling has pulled up short in the oxides, and there's still more to go. And then there's some extensional drilling. When we do our resource upgrade, we'll be really focusing on strategic drilling. So we're not all about saying we're going to drill 30,000 metres, et cetera, et cetera. We want to spend as little money as possible and get this through to a point where we can start feasibility work. And then later on, we'll start looking at the T3 to T7 prospects. David Hobby, our Chief Geologist, and I were just discussing then maybe doing some soils. There is some soil work we've got to recollate to publish, but there's some really interesting stuff happening on this block, and we expect to bring out some good targets. Okay, through the cross sections, and it looks like I'm over time, but you can see the drilling on the left-hand side is well under the pit shell, right at the northwestern end of the pit, and then we step in a couple hundred metres and we've still got a lot happening under the pit. Same again here, and you can see a lot of holes pulling up short, and same again here, you can see all these holes have been drilled and finished in mineralisation, so it looks really exciting. So a timeline, but I'm over time, so you can look at this on our website and in our presentation, but MRE update later this year, and then we'll go from there. And that's it. Thank you very much.